Hello, good afternoon, everyone. Welcome once again, and thank you for taking time out for today's session. Today, we are happy to initiate a new webinar series called Wealth Wisdom in collaboration with Network FP. Here, we are trying to aim to educate investors and help them manage their investment journeys. So, a quick look on what we can expect today. So today's first webinar would deep dive into asset allocation and how it can help you achieve your financial goals. It would be presented by Puneet Oberoi. He is a renowned investment advisor, and he'll be taking us through the nitty-gritties of how you can plan your financial goals to achieve through your investment journey. And to all our new members, I would just take a minute to give a brief introduction about MProfit. MProfit is a multi-asset portfolio management solution provider where you can track your multiple assets at one place, whether it's your own investments or your family investments. You can have an overview of your portfolio across multiple assets here. We cater to various segments like HNIs, family offices, financial advisors, and chartered accountants. Through the app, you can auto import all your trade data, and we have collaborated with over 700 brokers and financial institutions. And this, once the data is imported, you can easily, have access to your XIR and capital gains at one go. So this is about M Profit. And over to Gaurav from Network FP. I think he can give a brief overview of what initiatives Network FP has been taken and introduced our guest speaker for the day, Mr. Puneet Oberoi. Thank you so much.
Thank you very much, Anjani. All right, so this is Gaurav Burman, CEO at Network FP. Would like to take a minute to introduce about Network FP as well as also the speaker for today. So as you can see that Network FP is a association of personal finance professionals. We are an education body where we cater to the investors, households by conducting lot of investor education program like the one that we have today. I hope you will enjoy this session and take a lot of great insight from today's session. And on the other side, we also issue certification continuous education program to the personal finance professionals. So what we are doing in a way that we are bringing the investor community as well as the personal finance professionals community together so that you people can actually go ahead with a fantastic financial planning for you and for your family. Along with this, would also like to introduce today's speaker. We have Mr. Puneet Oberoi, who is going to take the session today. Uh, we are happy to say that Puneet is a founder and director of Finwise, Sampan Finman, and SAP Connects LLP Private Limited. He has 2 decades of experience in financial services industry. Puneet Oberoi is a certified financial planner and first batch of CFPs in India, and he completed his LUTCF from the American College in 2007. He is a certified life planner from Kinder Institute of Life Planning. He is currently coaching financial planners across India and is also subject faculty at GIMS, a business management school. So without taking any more time, would like to request Puneet to please come over and take us through today's session.
Thank you, Gaurav. Thank you for wonderful introduction. Thank you, Anjani, for putting us across MProfit and Network FP. I think we all here to learn something, and let me put you across what exactly are we looking for today. So, to brief you, Network FP knows me very well. They know that I am full of energy, and I need energy from you participants, and that will come through your questions on the chat box. So I'll be wanting that to happen. So let's have an interactive session. Whatever queries you have, I'll be asking certain questions. Let's answer those. Let's be participative. Are we okay with this? Can we have some yeses or on the chat box? And yes, if it's everybody's ready for this. Yes, awesome. Thank you, Sanjay. Yes, Krishna. Thank you, Michael. So let's look forward to learn something which can be fruitful for each one of us. We all are gearing up. We are all working very hard. So let's understand how to manage these funds and how to manage our assets also. So today, let me put you across. So this is a topic which is very close to me, a deep dive into asset allocation, and specifically how we can achieve our financial goals. So I'll be talking and briefing about 4 topics in this, which is going to be majorly covered in this. One is, what is actually your real goals? A lot of us don't actually understand that. So let's deep dive into that. Then different avenues, investment avenues available for the investors in India. We all have so many things to manage, but we don't understand what to invest and where to invest. So let's look forward to that also. What is the importance of asset allocation and portfolio rebalancing? What exactly is portfolio rebalancing? Let's understand that. And what is the major, which this question comes to from every investor I manage, that when should I redeem my money? So let's understand that also. These are the four major points which we'll be covering over there. To start with, I have first question in your hand, which is for you. Let's answer these questions before going ahead. So if you're given this question, what option will you choose? If you get 5 crores now, if I give you 5 crores today, or if I give you just 1 rupee today and double it every day, what will your choice? Will you want 5 crores or will you want to have a second option? Option 1 or option 2? Second option. Oh, very nice. One. Okay, great. Or double it every day. Option 2, option 2, option 2, option 1. No option 1. Nobody wants 5 crores right away. Option 1. Great. Ganesh, thank you so much. Okay, great. Nobody other people don't want anything. So we have a lot of people over here. We are on 60 plus people. Yeah, 1 and 2 both. Okay, that's good, Sunil. You don't want to leave anything out of it. Oh, great. So to nutshell on this, a lot of us are saying 2. Do you know what is the difference between 5 crores and what will I get if I invest rupee 1 and double it every day? Any guesses what will the amount? Compounding, absolutely. Oh, awesome, Preet. Oh, around 53.7 crores. You are very close, 55 crores. That's the number which comes out. So this is what we need to understand. It's not about numbers. It's not about just compounding. It's about perception. We outlook it a lot of time while investing. We make this mistake on looking at that on this different angle. We miss out a lot of things and buy the wrong investment products also in the same criteria. So let's not make those mistakes and understand the right thing, deep dive into those products, and then take the call. That's what the objective is. So Preet have deep dived it. They understand. A lot of us have written down to those people have understood that we have to understand and then only take a call. So that's what my suggestion to everyone when we start on the investments. Now let's understand before going in. We all understand, we all are, as an Indians, we are being savings are being fed since childhood. We all are being told to save. Am I right? Every parent, everybody starts with one thing. Beta, save your money. You'll be needing for education. We are saving your money. Have a piggy bank. All these are being fed. And this is all being linked to something. Am I right? They will start with, okay, we are saving for your marriage. We are saving for your education. We are saving for retirement. We all know these goals. Am I right? Shirish, can you hear it? I think everybody is audible. I'm just hearing that can't hear. Yes, okay. So Shirish, there's a network problem at your place. Okay, so I'm just putting across that this is a very common thing that we all know these common goals. Isn't this a very common goal? If we have a house, we have a car, we have so first thing what we do when we start earning is look forward to buying a car or an asset or a bike. If we have a bike, we look forward to buying a next goal will be our car. Next goal will be a house. If we have a house, we want to have a bigger house. Even Dhirubhai Ambani, or sorry, Mukesh Ambani also look forward to buying Antilla. So something which is bigger than whatever he has bought for. So everybody in common has these major 5 goals. Apart from there might be multiple goals in life. I'm not denying on that. But we all know these goals are important. Out of that, there can be some priorities for certain things. Let's say somebody marriage might not be priority, but a house might be a priority for somebody. So out of this, what I see is one goal which is very, very, very close to everyone, and I think it is important, which is retirement. I'm just sharing why these goals are important, because we all know these goals, but in reality, we don't know the numbers to it. How many of you actually know that if you have a younger child, let's say 3-year-old or 2-year-old, what will be the need when he actually goes to 18 years? We don't calculate those things. We actually just work out that, okay, we are saving. We save for these goals. Even our parents saved for these goals, but they never had the numbers in picture. They never had that how much I have to save. So they never back calculated. What we need to know is what is the reality of it, how much I have to save. Then only I can plan it out. So to give you a real picture, I'll just quickly, I can't take all the goals. I'll take one goal as an example, which is retirement. Retirement is needed for everyone. Retirement is not that you retire today. It's about passive income. It's a second income which you need to generate. Now, I'll ask a question. How many of you, if you are right now in an early stage of life, I don't know, how many of you want to have early retirement? Yes, no. At what age? Okay, great. What is the age if you want to retire? I'm not asking your age. I'm asking what age do you want to retire? 48 to 50. Okay, great, Sunil. Okay, 55. Okay, great. ASAP, Sanjay. Okay, great. Okay, immediate, 60. Okay, great. So a lot of people I do planning for, financial planning for, they all are looking forward to early retirements. But let's understand whether we can retire early, because if we retire early, we have a longer duration to serve ourselves from that retirement fund. So let's understand the numbers to it. Let's go and deep dive into it. So I'm just taking Puneet as an example. I can make myself younger today. I'm not 27 at all. I'm 47, but I'm making myself 20 years younger. So let's say 27-year-old, married, a young child. If he thinks he's 27-year-old, he's 27-year-old, he wants to retire, as a lot of us are retiring 55 or 50. He wants to retire at 50. He has 23 years to retire. That means he has 23 years to saving. Now, what we need to look forward to when we are trying to figure out what is our retirement corpus or how much we need to save, we need to understand first what is the expenses we do today. So let's say assumption is that Puneet earns around lakh of rupees. His basic expenses, what living expenses, if I talk about, is rupees 50,000 per month. Apart from his, if he and his wife survives, what is the living expense he will be needing? So it comes out to be 50,000 rupees as an expense. Now, what is the amount with this 50,000? Will it remain same 23 years down the line? The expense of 50,000 today, will it remain same 23 years down the line, or will it increase? It will surely increase. Can you guess what is the number of this after 23 years? What will be 50,000 rupees per month? It will increase, but can you have some guesses that what will be the number post-retirement? Let's say 23 years down the line, what will be the expense he has to do 50 years down the line, 23 years down the line? Around 2,50,000. Yes. So it will be approximately 1.9 lakh rupees per month. Now, the biggest challenge or myth is that will it remain same lifelong? No, it will also increase. So inflation will not stop. Okay, government will not say now you're retired, now inflation will stop. So it will continue. So at 60, it becomes 3.4 lakhs. 41 lakh rupees per annum. The same amount, which is 19 lakh rupees per month, 1,93,000 becomes 3,40,000, and by 70 it becomes 6,12,000, and by 80 it becomes 1.1 crore per month. 11 lakh per month, which is 1.32 crores per annum, which is big numbers. Don't you think it's a big number? It is huge. But look around yourself, there you'll find a lot of 75 to 85 age bracket people living around. And by the time you touch down that, the life expectancy is increasing. Doctors, medical technologies, all those things are increasing. You might survive till 90-95. I don't know. I'm just assuming. It's more the treatments are being diagnoses are being getting better. So you might have a longer expectancy. So what is the corpus required for this? It's approximately 6% share. I'm just assuming, these are just assumptions, giving you a numbers to it. If you reduce a little bit also, I have taken a lot of things as an exception. It's just a bigger picture. Now, what do you think will be the corpus required at 23? You'll be needing some money to survive on this next 30, 35 years of your life expectancy. What do you think will be the corpus required? It will be around 5 crore rupees, because you have to survive at that stage for another 30, 35 years. So 80, 85, you have to survive. If you retire at 50, that means another 35 you have to survive. 35, 30, 40, you don't know. And for that, you need to save 33,000 per month today. Now, think about this. A person earning a lakh of rupees and 50,000 as a living expense. Apart from other, he might be having children expenses, other things also. It might be the expenses might be 70 to 80,000, 70,000 approximately. Now, can you think that he can save 33,000 out of 1 lakh rupees for just one goal? He has child education also. He has a young child. He has other goals, house. He might want to buy a car or any other goal. He can't fulfill others if he just start pitching in 33,000 per month. So how can these goals be achieved? Can you guess how it can be achieved? So there will be multiple, like if I said all those goals, if you start planning those things in the right time, let's say you need 60,000 rupees for all those goals. Let's say child education or house and this retirement, if it concludes around 65,000 rupees per month, you can't do it just in a day. But if I say that you can do it, SIP will work, but how will it? 33,000 rupees per month. Then can he has also child education as a goal. He has a house as a goal. He needs around 70,000 rupees per month. Can he save it? He has a lakh of rupees as an income. He cannot. But if I say there is a possibility, if you can invest, you can start small. If you start investing 10,000 rupees for retirement, can he start 10,000 rupees per month? Obviously. And he actually adds 10% every year on the last investment. As I showed you the doubling of the money in the beginning, this is what is called step up SIP. Means whenever there is an increment, what we do, if we have an increment of 10%, we do increase our expenses to 10%. Can't we just, let's say if a person is earning lakh of rupees and he earns 10% extra as when next year comes in, means 1,10,000 is salary, can't he add another 1,000 to this? He can surely it. But because he does not know the goal, he's never doing it. He's thinking, okay, I've done 10,000 rupees for SIP for my goal, not understanding that goal will never be achieved. That is why I always suggest that you should know where you're heading to. If you don't know where you're heading to, you'll never be able to save it. Are we getting it? Are we clear on this? So identify your goals. You can get numerous options on Google. Search it out. There will be numerous options available to calculate your goals. You don't need anybody to do those things. Just search it out and get those things in line. Are we clear? Great. So this is what we need to do for investments, for goal planning, for each and every goal. Now, going forward, this is a strategy for goal planning. You need to understand your goals and take it forward. But what exactly is our expectations to investments? What is exactly we're looking at? Because a lot of time, end of the day, we want to know where we want to invest, but our expectations are different. What exactly are we looking forward to as an investment? When we want to invest, what are the things which we want to look at before investing? What everybody wants. Don't we think these are the 4 points we all are looking at? Saving tax or tax-free returns, secured investment, liquidity, and most importantly, assured returns. Am I right? Is it right? Yes? No? Assured returns, liquidity, secured investment, tax-free returns. Anything else do you think there is something which has left around? Something which is missing over here? Any guesses what is missing over here? Equity, okay, no, so that is a product line. I'm not talking about equity. But what is most important is high returns. Yes, Ganesh, awesome, great. So everybody comes out to me and asks me higher returns. So what is high returns? What is your expectation to higher returns? Can I have numbers to it? What is your expectation as higher returns? There's no number to it. Can I have some numbers? 15%, okay. Anybody else? At least 15%, depends on goals. Double the inflation, okay, 12%, 13%, okay, great, 15%. So decent people over here, because what I get to hear every day is, yeah, if we are generating 20, 18%, 19% also, yeah, I don't think it's sufficient enough. Then I ask them, what is the expectation to it? So can you guess what is the returns Warren Buffett, the biggest investor in the world, is getting on a year-on basis? Oh, yes, Sanjeev comes out 20-25%. That's what I was asking. So 21% is the annualized return of Warren Buffett. But do you know how many years he has been investing? And his portfolio comprises of certain portfolios which he invests into very high risk. But he has a very big research team which is working on it. Whereas when we are looking for to 21% of very, very high profile people who are sitting down, just accessing all those things and taking that risk and sitting down over a period of time. You can't just get, he's been holding Coca-Cola since last 50 years. That's how it's made money. He's not made money in a day's time. So our expectation has to be in a decent way. Anything which is around 12% to 15% is a decent return. I'll show you some things which will make you understand those things. But before that, we need to understand that what are the risk attached to it. There are always a risk. When you go for higher returns, there is a higher risk also. But we can take and manage those risks very well. There are assets which we can take on which can be surely giving us higher returns, but a managed way. So what we look at is asset allocation. What we look at is investing consistently. What we look at is investing for long term. If we do those things, we can reduce risk. We surely can reduce risk. But to understand what exactly is, we know investing consistently is we all understand that. Investing for long term, we understand. What exactly is asset allocation? That's what we need to understand. Because a lot of people have this question, asset allocation hai kya? What exactly is asset allocation? What do you think is asset allocation? Can I have some answers? What do you think what is asset allocation? Karna kya chahiye? What should be done about it? What is rebalancing? What is profit booking? A lot of times we look forward to this, spreading your risk. Absolutely. See, diversifying your risk. But do you think how we are majorly as an Indians, where are we allocating ourselves, and how we are rebalancing our portfolio? How do we manage our asset allocations? 90% of the times what we manage asset allocations or we rebalances only our equity portfolio. Diversification is one thing. We do diversify as an asset, but majorly where are we investing is, look at this. This is one common asset allocation slide of one of my clients I'm just sharing. He is still in a very decent side of 53% in real estate. Majorly, if I look at 90% of our clients or 90% of the people are heavy on real estate. Heavy means 70, 80, 90% into real estate. Not realizing where is the liquidity. Where are the things where we can manage other smaller assets or smaller goals? So asset allocation is spreading of risk in the right way, first thing. Then when we are managing and rebalancing, now let's come to what we need to understand more is, what exactly is rebalancing? Before understanding rebalancing, let's understand when should we redeem. Isn't it a big question? Is it this question comes to your mind or not? Tell me yes. Yes, no? It's a big question. When should we redeem? When should we do rebalancing? When should we withdraw from money from the equity side and invest into debt? Yes, absolutely. I'll share you one example to it. This is a portfolio of one of my clients. He has invested around 19 lakhs. If you look at holding days, it's more than 15 years, almost 15 years. Average is around 14 years plus. He invested 19 lakhs. Currently, it's 1.2 crores. He's getting around 14.35% compounding return. And this is a real picture I'm showing you. Okay. He started investing in 2006. Now, tell me, what should be he doing? Today, the market is at a very peak position. He has done multiple times things. Now, tell me what should be done at this position where the war-like situation is there. He's getting decent return. The market is at peak of 65, 66,000. What should he be doing? Because he's getting almost 1 crore as profit. Should he book some profit, take it out? Yes, move into safe assets. Okay. Anything else? 1 year before. Oh, great, Ganesh. book partial profit. Okay. If I tell you, this is what you need to understand, that it's not again, we are going in for perception. This person's overall equity portfolio is less than 2%. What he should be doing. And he doesn't require this money. He's been holding this money since 15 years. And do you know how he made money? Because he didn't look at this portfolio for another last 12 years, 13 years. That's why he made money. If he would have seen those and been sharing those portfolios, it's not like that. But he's never bothered about it because it was a small investment of 20,000 rupees per month SIP. At that time, 2006, it was big money, but he could have invested 2 lakh rupees per month at that time. He's a super HNI. He just invested 20,000 rupees on my saying that, okay, just start investing. He never looked at 2008 market volatility. If he would have looked at that side, he would have stopped it immediately. 90% of people do that. Am I right? We told him, continue. We tell everybody to continue. See, currently also, a lot of people in higher markets stop investing into SIP, stop investing because the market is volatile. 2020, a lot of people stopped it. What benefit they had? So when we are talking about, it's a long term, what we talked about. It's a long term. We have to have patience. There will be markets ups and downs. We have to continue those things. If we don't need money, we don't withdraw. We will only do asset allocation only on the grounds of 2 things. One is goal-based and rebalancing of overall portfolio. What do you mean by overall portfolio? His overall portfolio is 2% equity. What does he need to switch to? He has multiple other assets. That's what a financial planner does. He suggests that, okay, you hold on. You need to invest more into equity. This is an old portfolio. He's now almost nearing to 10 to 12% of equity portfolio overall. But he has multiple assets, multiple factories, multiple other assets who again have been into real estate. So we are increasing his equity base. We are increasing the other side of his, but it takes time. He doesn't need those money currently. So why should we withdraw? So rebalancing redemption is only on the basis of goal-based, or you need redemption with profit booking is only on the basis of goal-based. Ganesh, you were right. You need to start looking at 1-2 years before the market when you need money. So let's say you need money at 18 years for your child education. Start looking at 15-16 years. Look at the markets, whether it's going to go down, but it's general assumption. So let's say today the market is volatile and I need money next year for my child. Let's start redeeming and moving to debt at this stage of life. Can't risk. I am already getting. So you don't become greedy at this stage of life. Are we getting it? So only goal-based rebalancing according to your portfolio. What are you holding in totality is important. Are we clear on this? Can we go ahead? Are we clear? Yes. Yes, absolutely, Jaidev. Redeem when actual plans to be executed. Yes, thank you. But won't this be challenging if underlying asset is going bust? So I am not saying that your asset, if asset is not performing, you don't move it. That's a separate story altogether. If that asset is non-performing, let's say real estate is not performing, then move out. I have seen people sitting down with stocks. Let's say one of my client invested into Union Bank, hearing from news from one person that, okay, GM of one Union Bank shared him that, okay, our stock is going to go like 1,000 rupees. We are getting a merger. This was 13 years back. And he invested at 350 rupees at that time. Currently, the Union Bank is still half the price and he's still holding it for last 13 years. What is the fun to it? I just got to know that he's still holding that money. So he would have withdrawn, made that loss of 50%, invested into any damn good stock, he would have tripled the money in last 10 years. So you have to move out according to asset class for sure. But redemption, goal-based rebalancing is something different, which we are talking. Are we clear on this? So coming out to the most important question, which we all are looking forward to, that, okay, we all understood about goal planning. We understand about asset allocation, rebalancing, when should we redeem. But what are the products available in industry? We should know those. Where should I invest? करना कहाँ है, पैसा कहाँ है? Should I only invest in equity, or should I invest into mutual fund? Should I invest into what all asset classes we have? A broader picture we all understand. Let's understand, deep dive a little bit more on those products, nitty-gritties of those products. These are basic products. Let me share you, but before that, I'll be putting you across that you as a person has to keep in mind certain checklist which has to be before investing. You need to check all those points. That what is the risk associated to this product? What are the past performances? A lot of time we make mistake of identifying new products without understanding, going on somebody's judgments. Don't do that. Look at those past performance. Look at those history of those fund managers or whatever who is managing that. Understand the liquidity, which is very important. Very, very important. Management, who's managing those things. Don't go for free tips. Always invest according to your goal. And if you need, better be advised by some professional. Very, very important. So let's now deep dive into products. Starting with first, let's understand the product side of different products which we'll be covering today. So these are the products. First is bank fixed deposit. We all understand, but let's understand more onto it. Sukanya Samriddhi, this is a government scheme, public provident fund, employee provident funds, life insurances, unit linked products, national pension scheme, very unique products, stocks, share markets, mutual funds, gold ETF, sovereign bond, and real estate. Real estate, we have a lot of insight on those things, certain inputs which might add on to certain things about REITs. Let's understand about those things. To starting with the debt side of it, because bank fixed deposit, Sukanya, public provident fund, life insurances, these comes into one debt product. When we talk about debt, debt does not only mean debt mutual fund. Debt means anything which is investing into fixed income products, where you're getting a kind of fixed income. There's no volatility to income products. That means debt side. So debts, let's understand debt on that. Bank fixed deposit is one first segment. So it starts with 7 days to 10 years. The availability is this. Then comes into 5-year FD for tax saving. There is availability of. So if I talk about when should be fixed deposit being done for? Why should we invest into fixed deposits? Can I have some answers on this? Can I have answers? Liquidity, okay. Safety also, am I right? Liquidation, okay. So should I invest fixed deposits for my child education, for my retirement, for my, let's say, for even taking passive income, retirement, anything which is more than 8 to 10 years? Bad idea. Okay, so we should not be investing anything, any fixed days for 10 years or 15 years. It's written down 7 days to 10 years. No, absolutely. So good. So I think everybody over here, MProfit, you have a great investors base for you. Why should it not be invested? Frankly speaking, we actually miss out a lot of time. I see a lot of portfolios which is continuing saving to FDs, which are, so there has to be parked for certain things. I'm not saying that FDs are not good. Only for contingency fund, you should keep either fixed deposit or debt mutual fund. That can be a good option. FDs can be parked only for short duration, 1 or 2 years. That's what I suggest always. If you're parking it for 10 years or 15 years, you are actually losing almost 40% of your capital in next 10 years. That's going to be the numbers, because if you are investing and getting an FD return post-tax as 4% or 4.5% and inflation of 6.5%, you're losing under 1.5% every year. That's what we don't understand. So a lot of time we do an FD for 2 years and then renew it for 2 years, then renew it for 2 years. Frankly speaking, I see a lot of portfolios. Whoever you are saying, that's absolutely, but you could go deep dive into it. There will be a lot of FDs which will be renewing again and again. So FDs are only to be done for long, short duration, not for long term. It's not that it should not be suggested. So I'll give you an example. one of my investor, he was 65 years when he came to me. He was a bachelor. He didn't have any family over here. What we suggested at that time for him was that was 2014, and he around had 4 crores of liquidity. So what we did was we did 2.5 crores of debt mutual fund at that time, because he didn't have that risk appetite. He didn't have that risk appetite of equity, and he didn't needed it. So what as a financial planner, we look into it, that what is money for? He has 4 crores as liquidity. He has assets apart from that. This is a liquid asset. Why should he be putting it money where he doesn't have that heart to handle it? So we invested into debt. We could have invested in equity also, but we didn't, because of the reason that he didn't need it that much. We invested 1.5 crores for 7.5, so for 10 years FD at that time. Why that was suggestion at that time? Because you look at 2014 history, he was getting an FD for 9.9%. So post-tax return was also ending up at 7%, which was okay at that time. So I said, okay, for your fixed income, for fixed expenses, let's do 1.5 crores into FD, and the rest amount goes into debt. Post overall returns, he's got around 8.5%, 9%, which was decent. So we have to look forward to all those things when we start investing into this. Okay. So let's go to FDs. I'm skipping. Sukanya is a good option for people who have young kid below 10 years. A person who has a young girl child can invest up to 10 years, means the girl child has to be below 10 years to invest into it. The best part is that it has 7.6% of rate of interest, which is tax free. You can't invest more than 1.5 lakhs, but 1.5 lakhs per annum, you can accumulate a good tax free return of 7.6%, which is equivalent to 10% FD if you talk about. Okay, that makes a good sense. So diversification again into Sukanya, that's a good product. PPF is a good product. We all understand PPF, but still give you an insight. It's a government-backed product, 15 years, then 5 years, and then 5 years. But I always suggest that if you have employee provident fund, is a different story, because at least you have a captured product. Why one should do a 15-year lock-in when I can't save? I can save into equities. I can get higher returns. Over here, there is hardly 7.1% of returns. Why should I invest into this? Any answer? Why should I invest into this? Why not invest into SIP and get not tax friendly? Yeah, this is a tax friendly because it is triple E. We're not taxed. Around 7.1% is tax free. We are just beating inflation by 1%, not more than that. But why should I invest if I can get 15%, 12% in it, or 10, 12% into this? Not just triple E is the only thing, because post-tax return of a mutual fund is getting around 11% or 10%. Why should I invest into 7%? See, diversification is always a good factor. Why diversification? Because you need certain commitments also. We are human beings. We tend to liquidate money. I've seen people doing their SIPs for longer term, for their children, for this education, for that and this, but they redeem after 4th or 5th or 6th year. Have you also not done this? But you haven't redeemed your PPF. You haven't redeemed your EPF. Wherever there is a restriction, you are bound that, okay, let's take it out from mutual fund rather than this. So liquidity is also problematic in longer term. So if you can diversify small amounts of everything, it doesn't make a difference. At least you are beating inflation and accumulating some funds. When emergency comes, you have that money. Are we good? So PPF is good. EPF is around 8.15% per annum. The only point we need to know, whoever is employed over here, 2.5 lakh is the maximum now you can invest as an employee. Over and above 2.5 lakh, your interest is taxable. So you only get tax-free returns up to 2.5 lakh rupees per annum. That's what you can invest today. Okay. So insurance and life of ULIP. So I have questions over here, because a lot of people understand life insurance and ULIP. Tell me one thing. I'll give a comparison over here: life insurance and mutual fund versus term insurance. Why I'm saying so? Because day before yesterday itself, one of my client called me and said that, Puneet, I'm getting why don't you suggest me a ULIP? Why do you want to invest into ULIP? He said that it's a 10-10D benefit. What is 10-10D benefit for you? He said the tax-free returns. How much return do you get tax-free in mutual fund? I don't know. It's just 10% post-tax capital gain future whenever you're redeeming, and you get 1 lakh rupees an exemption whenever you're withdrawing. So if you're withdrawing 10 lakh rupees, 2 lakh rupees as profit, 1 lakh is tax-free and rest 1 lakh is taxable. And that to 10%, that is 5% in overall. Let's say even 10% if you are withdrawing 20 lakh rupees as a capital gain, then also you just pay 10 lakh, 2 lakh rupees, and 18 lakhs is the compounding. Now, what is ULIP doing? Whereas when you are investing a lakh of rupees per annum in mutual fund, you are investing complete 1 lakh rupees. When you are investing a lakh of rupees in a ULIP, there are a lot of charges, which is administration charges, life insurance charges. Nothing is free in the world. When you are going in for investment, lakh of rupees is not invested, 96,000 or 95,000 is invested every year. That means you're already losing 3 to 5% depending on the product. Minimum 3 to 5% is minimum. That means that your compounding starts with 95,000, not than 1 lakh rupees. So how much return can you generate from that? You'll be losing almost 4% every year up to 10 years. That means almost 40% is lost. Whereas mutual fund is generating you an annual return. So what you need to see, if you're going for insurances, go for pure insurances. And that's when you need those insurances. If you don't need it, it's an expense. Why are we doing it? Check out what insurance is needed. If you need that insurances, your family needs it, then go for it. Otherwise, if you're going for investment, don't get lured on these things. These are all sales tactics in the market. You need to judge it out what is right for you. Are we clear on this? Okay, let's come to the next point, which is NPS. So it's a government-backed investment. Do we all understand NPS? Have you heard about it? We all must have heard about, whoever has been into. Yes. Okay. What I'll be sharing about NPS is that there is a 50,000 rupees extra benefit in ATC. So if you're a business owner, or if you're a salaried, you can invest 1.5 lakhs in ATC. But NPS has offered you 50,000 over and above. So if you invest 50,000 on tier 2, you can invest that and get another tax benefit of 50,000 over and above ATC. So this should not be left around. Now, what is positive and what is negative about this? See, don't overdo into NPS. Why I suggest so? Because not just look forward to this, you have a liquidity challenge in NPS. A lot of times when you end up at that stage of life, when you are 60, you can't withdraw before 60. You have only options, limited options to withdraw before 60. So if you're withdrawing at 60, only 60% can be withdrawn. Rest 40% has to go for annuity. So let's say you put all your eggs in one as a pension product, only in this, then it will be a problem, because a lot of time you need liquidity. You might want some higher returns. You might be getting some other products where you might invest and get a better returns. You will be challenged because you'll be stuck in this. So what my suggestion is, balance it out, do an NPS which you think is going to be the right amount, which I can manage as an annuity. That's what you need to look at. Okay. So this is what NPS is. We'll take questions on anything which is there. This is what the structure looks like. Now comes into equity, which is the most phenomenal product. I think we all understand. Madhuri raised hand. Madhuri, you have any questions? Amritya. Yes, so not so good, as it does not allow to rename totally. Yes, previous slide. Okay, we'll take answer questions, and when we'll be open to questions at the end of the session, Q&A. Okay, we'll just wind up with this, and then we'll take the questions. So stock markets, I'll just cover on this. It's not, I'll have a question for everyone over here as a share market. We all want to invest. I get a lot of queries on why don't Puneet, I directly invest into stock market. Why should I invest through mutual funds? Does this comes into your mind also? Yes, no. And a lot of times it comes into my mind that, okay, I can earn more than what mutual fund can earn me. Yes. Yes. Am I right? A lot of people think about it. But tell me one thing. How many of you have seen SDFC's this top 200 product? or ICICI FlexiCap or any other product. Let's say SDFC Top 200. Have you heard about this? I'm just naming one product. I'm just don't go on the name of the company. I'm just saying, I'm just putting it across that I have seen in last 20 years, 25 years of my base of understanding. I've seen not a single mutual fund, not a single fund manager, not just mutual fund, not a single fund manager perform consistently for 20 years. So regardless of, they get a numerous backup, they have huge team of people working for it, they have research teams, 100 people working under them, they have got the best of the best inside knowledge about companies, they read out balance sheet, they understand everything, and then also they fail, they don't, it's not a consistency. If they cannot generate more than 14 or 15%, they can beat the benchmark by, let's say, 2 alpha, 2%, 3%. How can you, who is alone, who is don't have any research, doesn't have time enough, can do this? Can you beat benchmark, which is Nifty, or if you can beat index consistently for 10 years? No. Lot of time we only presume and look at the past performances of ours during the peak time. Lot of us got good returns in 2020 to 2023, invested in 2019, or luckily invested in 2020 post May, June, got good returns and start thinking that I can make money. That is what we all think about. But take it in a 10 years or 15 years time, you will not be able to. You won't have that much time. I'm not saying you should not do. I'm saying that people who can diligently work on this, if they have a full-time work on this, that they can research on the companies, they can work onto it, they have 3 hours, 4 hours of every day to work on this, and research onto it, they have some internal knowledges on those things, then try it out. But still, I don't see much of a fun, because you can't beat benchmark on a consistent basis. That's what my take is. Still, you want to try, then you have to have that bandwidth. Don't just jump into it just because that, okay, I can make money, I can make top five stocks, I can pick it up and make returns. Overall, you won't be able to make portfolio returns. That's my takeaway on this. Coming on to mutual funds. So I'll come over here as an index fund. How many of you understand index funds? Passive income, passive funds and active funds. How many of you heard about this? A lot of news, a lot of index funds, a lot of things have popped out. We are hearing it from international markets. Yes. So there are two kinds of funds, passive funds and active funds. Active funds are those funds which are managed by active portfolio managers who are managing, who are guiding it, which funds to put across, which stocks to put in this, which stocks to take it out, which percent, how much percent I have to hold in ICICI Bank, how much percentage I have to hold in TCS, how much I have to hold in, let's say, ONGC, what percentage I have to delegate. That's an actively managed portfolio. Those are generally called the mutual fund active portfolio. Now, when we talk about index signifies the benchmarks of, let's say, Nifty 50 is top 50 stocks of India, or BSE Sensex is top 30 stocks of India. These are just few index. There are thousands of, not thousand, tens of indexes in the market. Momentum 30 stock index, let's say equal weightage funds index. There are multiple indexes available. You have to choose out the right index. We still choosing out the old way. We are still choosing the indexes in the same plain vanilla stage. Let's say top 50 funds. If you look at top 50 stocks today, and if you have invested last year in an index fund and invested into any active fund today, the index fund is non-performing as compared to active fund. Whereas in last 4 years, index fund performed much better. The only reason behind was that maximum people invested into index were the large cap funds. And in 2020, the large cap boosted like anything. But this does not happen every year or every time. So what my suggestion over here is, India is a growing market. Don't follow international market just on blindfoldedly. that, okay, index fund, everybody is suggesting, US is suggesting, why not over there, everybody invests into index fund. Why are we investing into active funds? We should invest into active funds. Also, majorly, I said why I'm saying that 60 to 70% should be invested into active funds, because there is another 7 to 10 years of active management and new companies coming in portfolio. If you don't invest into those stocks, you will not make money. There are a lot of companies which are coming in as a mid cap and lower small caps, which you might not get that portfolio in those indexes. So those can be done only by these active managed funds. They can understand those companies, and you might not take up those things. So my suggestion is at least 60 to 70% of active funds. Indian markets are growing great in next 10 years. So invest into active funds, also invest into index fund, but choose the right indexes also. Just not sit down with the top 50 stocks or top 100 stocks indexes. Am I right? Okay. Does it make sense? Now comes into gold. I'll just end up because I have to take I'm short of time. I'll just wind up, and because I have to take a Q&A session also to take on this physical gold ETF and sovereign gold bond. What is the right pick of this? So if I talk about gold ETFs, if it's more of, see, physical gold, we all understand there are nitty-gritties to it. So keeping them is an issue. Managing, selling, and getting that cut is a difficulty. So what is the better part? Whether we should invest into ETF or we should invest into sovereign gold bond. So if I talk about ETF, so ETF is a good option when we need liquidity and we have to track. If I talk about mark-to-market gold exchange rates, then ETF is a good option. If I want to invest in a longer term, see, how much percentage one should invest into gold? One thing one should know about first. See, a lot of time we invest too much into gold also. That should not be the criteria. If we are investing, physical gold is a waste, absolutely waste. Look at your lockers, it's being locked. People don't use it. My wife hasn't opened it for last so many years. She's just saying that I have to take it out, make a new one. That's how we, every 4-5 years, they take it out, make a new one. Wastage of money. That's what we do with the gold, physical gold. But if we are keeping it for assets, a lot of time we buy it for assets, then sovereign gold bond is a fantastic tool. Why it's fantastic? Because first thing is you get interest on into it. So if you buy bonds, you get 2.5% returns annually, which is biannually, sorry, every 6 months, 2.5% per annum, which is taxable. But the capital gain is tax-free. The best part of gold, wherever you buy, whether it's physical, whether it's ETF, you are taxed on the capital gain. Over here, the taxability on the capital gain is tax-free, which is beautiful. You have 8 years of lock-in, but you can trade it on the exchange. If you trade it on the exchange, it is treated as long-term capital gain as an equity one. So 10% you pay on the long term after 1 year, and you pay that taxes. Whereas gold ETFs, the immediate transaction comes into, whether it's 1 year, whether 2 years or 3 years, you are taxable on the short-term capital gain, means immediately taxed on you. It's on the your income itself. We'll take questions on these if we have in the later part. Now comes into real estate. We all know diversification is again important. A lot of times we have seen and faced the problem of investing too much into one sector. In 2009 to 2011, not just 2009, 2004 to 2011, a lot of people invested into new housing societies scam. They got stuck into badly because, and I know lakhs of people invested into some real estate where they're stuck today. So I have got, day before yesterday also, I got a client who, she was saying that we badly burned our hands in the residential property. I'm not saying residential property is bad or something, but if you are investing, invest into wisely into something, whether it's commercial, whether it's industrial, look forward to markets, and diversify over here also, not just put all into residential products. It might not give you returns in longer term. Again, windfall gains can happen, but don't go into that kind of thing. Now comes into REITs. REITs is a beautiful product. Why it's beautiful? When you are wanting an income source, fixed income source, and want to invest and diversify into real estate, this is a good opportunity. Why it's very good? Because it invests into income producing, they can only invest. So REITs is a kind of mutual fund for real estate. You can invest minimum of from starting from 50,000. You can't invest into real estate with 50,000. So over here, there are three. The limitation is that there are three organizations only. One is Embassy Office, one is Mindspace, and the third one is Brookfield. These are the three organizations which are currently available who are doing REITs in India. Taxation is as per equity, dividends are taxable. 90% of their growth has to be divided into dividends. So they have to invest into anything which is giving you income generating assets. So it cannot invest into constructing under construction companies. They can only invest 10% into it. So it's a beautiful product. They have to give you NAV twice a year. They have to declare. So everything is managed by the regulators. So it's a good product to diversify into real estate. Are we good to go? So this is what the assets look like. Real estate, gold, equity, mutual funds, debt side, all these diversification is important. You need to choose out and fix up. There are new products which are coming in, understand those products and then go forward. So this is for summarizing. I'll be putting across that we understand our real goals. We now just understood where to look at, what are our real goal values. We need to identify those goal values and then start investing. Don't jump into just before that. Understand it, rebalancing, what is actually profit booking, what exactly is, when should we redeem and when should we park our money, where should we doing that, and understanding the venues of diversification. So many products we have discussed. There might be other questions which might come onto your mind right now. I know there are a lot of questions which are coming in. But before that, I'll just hand over to Gaurav, because he has promised you some takeaways, which are real takeaways for you for the day. I'll be coming back in 2 minutes after Gaurav comes in and speaks about what are the gifts for you. So after this, I'll be taking the Q&A session. Over to you, Gaurav.
Thank you very much, Puneet. First of all, what a fantastic session, Puneet, you have been conducting so far. We just loved it, with the passion that you have shared all this information. I'm sure all people who are there with us, they must have appreciated it highly. Okay, now all those people who are there with us till the end of the session, we would like to share with you that there are three gifts being offered to you people, and you can enroll to get all these three gifts with one of the link my colleague Andrew will be sharing in the chat box. What comes with the gift number one is definitely, it goes without saying that as I spoke in the beginning, that we are an education body to a lot of personal finance professionals, and in fact we have thousands of personal finance professionals who are very competent and who are highly learned and qualified people who can help you with financial planning. This link, this directory of personal finance professional comes absolutely free of cost to you all people. You can just go and check their profile, and whoever is present in your vicinity, you can go ahead and have a session with these people absolutely free of cost. Along with this directory, I would also like to take you ahead to the next slide in terms of what is it that you will be getting over and above this directory. So the gift number one is free email course. So for the next 31 days, all those people who will be enrolling with the link which is given in the chat box, right? If you enroll to this gift number 1, 2, and 3, you will be getting some 31 financial tips from our side to improve upon your financial journey and ensure that you do the right things when it comes to investment, wealth management, so on and so forth. So very, very insightful, great 31 tips, which will make your journey absolutely enriching and easy. Gift number 2 is, you can see that there are some ready to use downloadable tools available, which will make your financial planning absolutely meaningful and much more systematic. So 3 tools that we would like to give to you all. The first one is financial statements, where you can actually do the calculation in terms of all the income that you are getting in a month's time, how it is being spent over various different types of expenses that we have during the month, and how you can actually find out the surplus that can be set aside for various investment options that Puneet has shared with us in today's session, right? So you get to know the surplus, and you also able to find out that where you are spending unnecessarily, all those unnecessary spendings can be checked, can be stopped, and more money we can actually start putting aside that goes for our meaningful financial journey. Number 2, financial information organizer. So all kinds of investments that you have done, be it mutual funds, be it equities, stocks, gold, real estate, insurance policies, and the traditional investments, any government schemes that you have taken, all this data need to be kept at one side in a information organizer. So your family, let's say, if anything goes wrong, your family is absolutely aware that what kind of investments in the insurance that you have taken and where the information is there with you. So you get to use this particular tool, put this put this information there and share it with your family, so they are also pretty much secure about the actions that you have taken for them. Now, number third is goal metrics. Like somewhere in the beginning, Puneet also shared with us that the investment we are making should be linked with the goals that we have. So there may be short-term goals, medium-term goals, and long-term goals also. So you need to categorize all your goals into this metrics, which is going to make your entire financial planning much more visible, much more meaningful. So this three downloadable tools comes absolutely free of cost. And the third one, as I was mentioning in the earlier part, that we have the directory of personal finance professionals of 1,000 people who are there on this directory. You can get in touch with these people after going through their profile and get into a free consultation of 30-45 minutes. You can do a counseling session with these people, which will help you to do your finances absolutely fantastic. All right. So these three gifts are for those people who are there with us in this call, provided the link which is shared by my colleague Andrew in the chat box. Also, there is a scan code which is given here on the screen. Make use of it and enroll into these three gifts that we would like to offer you. So with this, I would like to call upon Puneet once again and would request Puneet to take over some of the
Thank you,
questions that
Gaurav.
you people have asked.
Thank you, Gaurav. And frankly speaking, friends, these are absolutely good tools. Yeah, absolutely good used tools. Every day you'll be getting some good tip out of it. So coming out to be question and answer, if you have any queries, I'm here to answer those questions. Now is the time. You can ask me whatever you have any query related to any topic on this or something which I can answer.
Yeah, Punit sir, you can keep the previous slide for people to scan. And Anjani, I have shared the link to you. You can share it to the attendees, please.
Yes, sure. I'm just doing that.
Thank you. Sarji, there is already a question in the chat box.
I missed it. Okay. Okay. Do you recommend making angel investment into startup? How much % can we allocate to that and how much make those investments? Okay, great. This is by Abhiram. Abhiram, frankly, absolutely, it's a new asset class. We haven't covered in this over here because it's a very it's a product which is coming up in a very structured way right now. So there are companies which have come up with this kind of mutual fund structure or VC structure over here. We only recommend investments into startup world when a person has achieved to a certain level. Means if you are let's say if you have invested in equity of 1 crore rupees, then you can think about not even 1 crore, even 5 crore rupees, then you can think about investing into startup. Why I'm saying so? Because startup investments needs at least 50 lakhs to 1 crore to invest. If you invest with 2 lakh, 5 lakhs, 10 lakhs, you will be burned like anything. So don't even think about investing into startup just with one company or two companies. When you are investing to startup, you have to end up with multiple companies investing just like a mutual fund. So investing into multiple companies means that investing into 30 companies, at least 4 to 5 lakh rupees each, comes out to be almost 50 lakhs to 1 crore rupees. So if you have 5 crore as an asset base where you have a consistent return in equity, you get around 12 to 14%, you have other assets in line where you have covered yourself, then you can invest into this startup world. Does it make sense? Anything else, Abhiram? You mentioned 60 to 70% actively managed fund, but do you suggested that not a single fund manager has been able to deliver consistent returns in past? Absolutely. So I'm not saying that you invest into one mutual fund. You have to diversify that too. And that's why you need a right advisor. If you have that kind of a structure, if you can understand, if you understand the market, understand the structure of the mutual fund, you can invest yourself. I'm not saying that. But again, you have to pick up the right products over there. You have to monitor those mutual funds. You have to monitor only those, whether those mutual funds are performing in the right way or not, yearly, consistently beating the benchmark or not. So you don't have to manage too many things. On a year basis, you just have to monitor whether this fund is delivered. So let's say I invested into X large cap, and X large cap giving me a return of, benchmark is giving, let's say a large cap has 100 top 100 stocks. So let's say top 100 index is giving me a 10% return, and this XYZ fund is giving me 12%, 13%. It's good. Okay. But as soon as it start giving, 1 year it gives 9% and the benchmark gives 12%, I don't have to exit on that side. There might be some reason, but if it is consistently giving below the returns and the other funds in the same category of giving 13%, 14%, then that's the point you have to look into it, why this is happening, whether the fund manager is not performing, the team has changed, what has been done in that mutual fund, you have to study that. That's what professionals like us do. We understand what mutual fund has to be invested, why, beta. There are a lot of ratios which you need to understand. Again, it's technicalities, but still there are a lot of options available. Even this MProfit might be giving you a lot of insights about those things. You can search those things, choose out the right product and give that right agent. So diversify in that also, and also monitor. I'm not saying just sit down, sit tight and forget it. No, you have to monitor, but don't monitor stocks. You monitor the mutual fund. Does it make sense? Do you propose silver also as an investment apart from financial? So commodities is, again, silver is a commodity. I always say commodities, you can put across, but I always suggest not more than 5 to 10% of your portfolio into commodities. 5% is decent enough. Gold and silver is something which you can hold it for 5 to 10%. Other commodities you have to be, because those are not something which can hold and take in your hand. Physical asset should be available for that. Only invest into that kind of commodity. Diversification, again, silver as an asset, you can do that, but not too much, because these are not going to give returns. These are more of safety assets. These are more of, it's not going to give you more than 7 to 8% in a longer term. Any gold, any commodity, if you look at it longer term, it's not given that, it has not broken that barrier. It always, the cycle is 30 years for gold. It comes back after 25 to 30 years in rotation. So asset class is always this, that you have to, can it be worth to invest in REITs products? Yeah, if you want a consistent returns, REITs is not again a immediate return basis. It's more of, if you want to invest into commercial rentals, if you want to invest, a lot of people have burned their hands in commercial leasings. So if you don't want to burn your hands, give it to professionals. They will manage it. They will give you a return. The annual returns of REITs are coming around 10 to 11%, which is decent returns in as far as annual returns is concerned. Commercial return with 10 to 11% is a good return. Again, diversification. Okay, thank you. What's the right index fund you would like to suggest for a moderately aggressive investor? Okay, so I'll suggest that you need to have a overall portfolio mix of small caps if you want to, and really want to take forward to those mix of. So there is a fund called index fund called equal weightage fund, which is Nifty 50 equal weightage fund. That actually gives you 2% each in all equity funds of top 50 funds. So this is one good fund. Momentum 30 index is a good fund. Small bit of 20 to 30% into small caps, small cap index funds and mid cap. That will be a good portfolio for you. So if you are only investing into index, if at all. Anything else?
Okay. For the people who are not able to use the link on the chat, please use the QR code and use your phone to scan the code and you can fill in the form.
there was a question I missed out. Is it Sanjay asked that it's not true that post-retirement expenses go down except medical care? How to get exact corpus post-retirement? So see, corpus, what we generally suggest is that whatever is your current medical expenses, current living expenses, if you think you and your spouse is left around, leaving apart your children, because those expenses will be on off your radar at that time. So we keep generally that same cost as a thumb rule, because there's no fixed thing. Somebody might reduce his cost to a certain livings, they might reduce their livings at certain level. Somebody might want to increase their living post-retirement, want to roam around, want to explore world. What exactly you are looking at, you have to focus on that. So if I want, okay, I want luxury at that time, then I have to increase the expenses part to it. So let's say I have calculated 50,000. If somebody who wants to put across, okay, I want to be in luxury at that time, I want to save more for my luxury at that time, I should have a driver. I won't be able to drive. I need a driver at that time. So I need to add 70,000 rupees as expense today. So 70,000 post 23 years, then calculate that. So there are calculators available. Just put across today's expense. What do you want at this stage of life? Calculate that. For every goal, you need to look at today's value and put that as a number. That's how you need to calculate your goal. Does it make sense, Sanjay? Thank you, Shiv. Thank you so much. Do give us the feedback. They're asking for the feedback. For sure. Acha, give thanks for the right index fund. You'll be suggest for moderately aggressive investor. Hope I'm not missed out somebody. I'm just scrolling down the old ones. I think we have covered. I think we have covered everything. Andrew, can we, do we have any questions left, or we can wind up the session now?
We have questions in the Q&A option too. Is it done, sir? These questions?
Which one? I've
The
taken
Q&A
all.
part. Next to the participant, there is something called Q&A. People have posted 2 questions there also.
I missed out that way. Okay, I was not aware of it. Okay. Ganesh, can you share the link? Is NPS? What is the percentage of a future monthly requirement should income from NPS? Come from NPS. What is the ideal asset allocation portfolio for NRI planning to allocate in 5 years? Okay, first is percentage of a future monthly requirement should come from NPS. So what I suggest is at not more than 20 to 25% of your future monthly requirement should be coming more than that. So you should have other avenues available for so any asset class. So when I talk about passive income, you should not invest more than 20% in one asset for one income. So NPS, you should be keeping it for 20%, let's say real estate 20-25% as a passive income, because a lot of people invest into real estate for passive income, let's say rental income also. Invest into mutual fund for those things should be higher on that side. Looking at what is so when you calculate your pensions, there are 2 parts. One is pre-retirement and one is post-retirement. And in both the side, what will be the ratio of debt and equity? You have to look at that. So if you put too much of debt into both the sides, even post-retirement, your corpus will start dipping in. So you have to check it out. What is the accumulation phase? Means when it's pre-retirement accumulation phase, and post-retirement, which is your distribution phase. In distribution phase also, your equity exposure has to be higher side, otherwise you will not get returns. So if you don't beat the inflation more than 10 to 11%, so if you invest more than into, let's say, real estate as an asset, and that's generating you not more than 7%, 6%, then and that's on a higher side. A lot of people invest into real estate, 70%, 80% in real estate, then there is a challenge. So invest wisely divide it into 4-5 sectors, distribute those things, and calculate your post distribution or post retirement whether how much percentage of equity has to be needed. That will come out only after you create your corpuses, that this is what my expenses and I have to survive this portion. You'll already get you automatically get that. Does it make sense? Second, Manish, what is the ideal asset allocation portfolio for NRI planning to relocate? See, the biggest challenge for NRI is that post-tax, post certain period, you have to calculate not just the returns of investments over here, the rupee deflations. So don't invest too much into Indian equity markets. Whatever you can hold and put as an expense over here, put that money into as an investment over here. Because if you want to withdraw and take it away, it will be a challenge. Taxabilities will be higher, 20% TDS will be there. Might be which country you are moving, because again, a lot of challenges comes in that if you're going to US or Canada, a lot of mutual funds don't let you enter, a lot of equities you can't buy. So that's the challenges which you have to see. So when you're relocating, look at this, that whatever money you're requiring in India, only put across that money. Okay. Hope it answers your question. Is NPS tier 2 a better option than large cap index investing? So Arun, again, these are two different products. NPS is only for when you are talking about pension. When I talk about large cap index fund, it's a pure liquidity you have available. Pluses and minuses are both sides. Liquidity is a pro also and a negative also. But too much liquidity also harms. So NPS is good for your consistent holding, means you will not withdraw that. You're bound to don't withdraw that money. But when you are investing into large cap index fund, you might withdraw. But don't put too much on the NPS also. Again, that's what I'm saying. Okay. Okay. Does it make sense? Okay. Great.
Yes, sir. There is a small announcement. Team, I have shared the link in the chat box. Your feedbacks are more valuable for us. Please tell us how was the session, and also let us know what kind of topics can be covered in the upcoming sessions. We are planning for a series of sessions coming up, right? And these free gifts is completely customizable for you people, right? We have got it for you, and please make full advantage of it and use the link, or you can use the camera to scan the code, and once you use the camera, you get the link there. Click on the link and you will be able to fill in the form.
Thank you, Andrew. Thank you, everyone. Thank you, Puneet, for the amazing session. I think we all can now plan our investment journeys better. Looking forward for a few more sessions ahead. Thank you once again for attending, everyone.
Thank you, everyone. Thank you so much. Thank you so much.
Thank you so much, everyone.